Happy Friday, Adam.
Happy Friday, Minhua. How are you doing?
I'm doing well. How are you?
I'm doing well. It's beautiful outside.
I know.
Really weird start to the week with the rain, but we seem to have recovered. So happy. Long weekend, I guess we have prepared for us, right?
I know. Is there any difference? Now we have a long weekend or a regular weekend.
Thank you, Minhua, for reminding me of
I
that.
think it will make a difference in your business because typically you guys are really busy on Monday, right?
Yes, it just means that we're busy on Tuesday now. But I
Oh,
find it
okay.
interesting because I think this weekend, right, they're LA County, Orange County, are they opening up the beaches and parks?
I think that they even did partial opening for the past 2 weeks. I know Laguna Beach is definitely officially open.
Wow. So
Parks, I
those
think they just rope off the picnic benches. I don't know if they take out those caution tapes off now. I have no
mm,
idea. I still haven't really been anywhere except for all the showings following very strictly the California Association of Realtor rules and CDC
nice.
recommendations. So let's introduce ourselves again.
Oh my goodness, I think everybody knows this already, but at this point, but my name is Adam Barreto. I'm a mortgage loan advisor, NMLS number 1034324. I'm here to provide insight on the mortgage market.
And my name is Minhua Gu. I'm Realtor. Okay, so shall we dive right into the market? Any updates you want to share?
So if we're going to touch directly on the mortgage market right now, a couple of great things have been brought to our attention this last week. Pretty much, Fannie Mae and Freddie Mac have come to an agreement where they're not going to they're going to allow people to purchase or refinance within in about a 3 month period. I think a week ago they were requiring everyone to wait a year before they were willing to take on those
Mm-hmm.
refinances. So that's huge, especially with the way the market is right now, with rates being down. Giving them the opportunity to save in a shorter period of time makes complete sense. So thank you so much to Fannie Mae and Freddie Mac and FHFA for making that happen, which will be huge to all of you guys. So
Mm-hmm.
as far as rates are concerned, we're still pretty relatively low. We dipped under 3% this week. I think we're at roughly in the mid threes on the FHA loans.
Mm-hmm.
So there's a lot of opportunity for people to purchase and really put themselves in a position to buy, at a little bit higher value than I think they initially anticipated. So
Mm-hmm.
what about you? What's going on in your marketplace?
Yeah, I have two really good numbers coming out. So essentially, the median price of single family home and other types of homes price is out this week. So median price of sold single family homes in LA County is 565,000 in April 2020. In March, it was 567,000, so essentially the same. And in Orange County, it's 861,000.
Wow.
And in March, it's 882,000. So very small change. No, again, no major price deterioration. And both price actually increased year to year. In LA County, it was a 3.9% increase from April 2019 last year, and for Orange County, it's a 4.4% increase from April 2019. So it's still a pretty good increase if you are considering invest that amount of money. Your money basically increased actually around 4%, 3.9 and 4.4%. So I think that's relevant to something we're going to talk about, buying versus renting, building that equity, building that increased value. I hate to ask, but I have to. Do you think the rate will drop below 3% in the future, let's say later this year?
So the general consensus is yes. We don't know when. Like I said before, we dipped right below 3% now.
Mm,
On a 30-year fix on conforming loan levels.
mm-hmm,
Being under 510, 400, we're right in that area. Obviously, high balances are still a little bit more of a higher risk, and so
mm-hmm,
investors are still not priced as great,
mm-hmm,
but they're modestly improving as the safety of the market is coming back. So I would say that later in the year, we do anticipate being in the low threes. I don't know if we'll actually drop below the 3%, but I have a weird feeling it may happen if we do get a second wave that's coming through with COVID. So I'm
mm,
praying, it's a catch-22, right? It's like you're praying that rates go down, but you're also praying that the second wave doesn't come. So
mm,
it's a little difficult to anticipate. But again, I think waiting may not be the best option. If you can find a rate that you're comfortable with when you run the numbers, right? That makes sense to
mm-hmm,
you for refinancing, or if you're looking to purchase, that you find something that makes sense to you, that you lock it in versus waiting on it and possibly watching the market turn on us and rates go up because then
mm-hmm.
investors are getting scared, right?
Mm-hmm.
So
Gotcha. So the opposite, if the opposite of waiting can be more costly, correct?
yes. I mean, I think if we go back like 2 months, you can see that the market changed dramatically where some people, reduced or added overlays on their FHA guidelines, which is what we discussed like 3 or 4 weeks ago. Some investors who are doing non-conventional, like qualified mortgages, which are like those bank statement loans and whatnot, completely jumped out of the market for a minute
Mm,
because their investors, they couldn't sell them off. So
mm, mm, mm.
rates were really high. So it's like there's no real purpose in trying to sell off those loans. So a lot of people got out of the market. Even on, like I said, high balance loans, people freaked out. Jumbo loans, there's a lot of companies, even major banks, that sort of got out of the jumbo market for a second
Mm-hmm.
because of all the fear that was going on out there. So if we do anticipate a second wave that's coming through, I believe that we have to be wary of that. So not only are you competing with other buyers, inventory, but possibly a second wave that can change the outcome of your loan if you are not a standard cookie cutter W-2 uh,
Mm.
borrower.
Okay. Understand. So that just means even the rates go down doesn't mean you will get that low rate. Well, Adam, we've been anticipating for you, who's very passionate about numbers, to really show us a very detailed picture, number wise, what's the difference between buying and renting. And I want to tell you, New York Times just put out a new piece, and that really, I think, more applied to New York area. That if your, I think the conclusion of the article is that if your rent is $834 less than your monthly payment, it's worth renting. However, I think the major fallacy of that piece is that it didn't um, count into the potential tax benefits and the potential growth of the equity. And to share with us how the equity can grow and what potential or tax benefits can be. Correct?
Yeah, I hope so. So, I'm a mortgage loan advisor. I am not a accountant. I'm not CPA, anything like that. So, based off of websites, I will quote that there are specific items that you can deduct as a homeowner. One of which is your mortgage and interest payments, your mortgage points that you paid. You can write it off your state and local property taxes. If you had a HELOC and you used it for purchase or home improvements, you are able to write off the interest on that one. So I'm going to get that out of the way, and then we'll be able to jump into my screen. So give me 1 second.
There we go.
So the scenario that we came up with, I believe that the prices in Lakewood's a little bit higher. I could be wrong. Minhua, correct me if I'm wrong. But
Yeah.
the scenario that we're using is we like to use round numbers, and so the purchase price is about 500,000. We are anticipating a 10% down, which is roughly 50,000. Rates. This is not a guaranteed rate. Just want to make sure that we understand that. But rates are down. So for all intents and purposes, we are using a 3.25% interest rate on a 30-year fixed. We do, on a standard, use a 1.25% property taxes, which again, when you pay your property taxes, you are able to write off. So I'm just sort of laying out the scenario for you. Annual maintenance, we estimate at 1,000. It could be more or less depending on your property. Housing association dues annual. We used 1176. Insurance 800. We assumed an appreciation of 3%. If I'm not mistaken, Minhua, you said that from April of last year to this year, we were in the LA County area. We've moved up about 3.7 or 3.6%.
We did 3.9, so we're 3.9. Close to 4, and it could be higher than 4. But as you mentioned here, like a 3%. If you see a 1% in appreciation, that's really low.
Yeah,
for housing market. So 3%, I think it's reasonable. Definitely achievable in Southern California.
Absolutely. So we're using for tax purposes, we're using a 28% tax bracket, or 28% tax bracket. It just depends on your situation, but for the scenario, we're going to use that. Monthly mortgage payments. General inflation, we're saying 2%. And that gives us a total of 1949, just under 1950 for a monthly mortgage payment on there. We're estimating that the cost for a similar sized home, if you're just renting, is about 2,000. We have seen rents increase pretty dramatically over the last probably 4 or 5 years. I will defer to Minhua about, I don't know where rents are at over the last, say 6 months. But I imagine because of COVID, it's sort of flattened out. There hasn't been as much of an increase, if any, over the last, 3 months. But for again, this scenario, we're going to use a 3% increase, which is pretty standard. And if I'm not mistaken, California law, right? Our Governor Newsom, did he pass the law where he it's sort of like rent control?
It's not even rent control, it just capped the increase rates. So it caps the increase rate, but plus the inflation. Don't feel that because of the assembly bill is passed that it's rent control. First of all, your landlord cannot increase rent. They can still increase rents, and their increase rate is capped then plus that inflation rate. Our inflation rate is possibly historically all-time low right now.
And if I'm not mistaken, I mean, there's always some sort of loopholes in these laws that allow for people to increase.
And it doesn't apply to certain buildings and certain homes.
Nice. So if we're going to break down the monthly costs on this stuff, we're looking right here. We're looking at home value at 500 to start, right? We're saying that you're putting 10% down. So that starts the debt at 450,000, which means that you have 50,000 worth of equity. The way this is broken down is actually by month, which obviously that's very, very detailed. But for the most part, most people look at it annually. But for this, we'll go a little bit more detailed so you can see it. So obviously you have the interest on debt that you're paying on it. You have the monthly mortgage payment. And this is the amount that's actually paid to the principal. So obviously you can see that it's very top heavy on the mortgage payment, which is always like that. There's always a breaking point that all of a sudden you are paying more on principal, and that's closer to like the 10-year mark. You have we put up here what the insurance was. This is the monthly insurance payment. This is the housing association dues monthly. These are the maintenance costs monthly, property taxes, which is what you can write off technically each year. Income. Go ahead.
Our mortgage interest that can be a write-off item as well. There was an assembly bill that should be voted today, but the assembly member actually didn't present the bill to vote. So we still can write off mortgage interest as well.
We can still write off mortgage.
Yeah, we can.
Okay, gotcha. And I believe, if I'm not mistaken, there's still a cap at 750,000, right? As the
right.
Okay.
And by the way, my friend, 700, not Adam, but everybody, 750,000 is your loan amount.
Yeah.
So if you pay 250,000 down payment, you can essentially still continue to write off your mortgage interest.
Thank you. So basically how this all goes is that you are adding in the total payment of the mortgage. You're adding in all of the fees, right, that you're paying monthly essentially, and then you're deducting the savings, right, the write-off. And so that gives us a cash flow of 2204 cost per year for that house. So if we're looking at your rent with an increase of 3%, year over year, we're looking at you're actually going to probably break about even at about 68 months, where your payment for, which is 5 years and 3 months, where you're actually be making the same relative payment. But here's the bigger kicker, and this is the more important reason why we do these calculations, is because what we're not factoring is your annual increase in equity, right? That is a huge part of home ownership. You are not paying somebody else's rent, you are paying your rent, which then builds equity so that you have either money to tap into in case of situations like COVID, or you come across, or you decide to sell. So the scenario below we're looking at is home values after 10 years. So you bought your home at 500,000 10 years ago. It is now, according to our conservative numbers, roughly about 675,000, right? If we're going to use the debt that you have over that time period remaining is still roughly about 347,000, which then you subtract, right? And then you end up with about $287,000 of equity after you pay off your transaction cost if you decide to sell your property, and on the first mortgage. When you compare it to the amount of money you're spending on rent, you deduct that $97,000, as you can see here. In that 10 years, the benefit has actually been $155,000. So that's quite a bit of money that you make. And with the way the current market is, it's not near this. This is a very sound investment in yourself and in your home and in your future, where there's not as much volatility, right?
Absolutely. I obviously I am a fervent believer in home ownership. One of the reasons I believe in that is this equity or this wealth you can build for yourself. You have children, that you are building this generational wealth that you can pass to your kids. And Adam just mentioned you can tap this equity when you sell your home, which is true. I think in the future we can also talk about how homeowners can tap home equity without selling their home. So essentially, your home can become your bank when needed. And it is also a very, very conservative, which means you're taking less risks, but very sound long-term investment.
Absolutely. I agree with you 100%. I think that the numbers speak for themselves. We can look at trends, but we know that real estate has grown year over year, even with the drop in 2008. It didn't take very much time for us to bounce back. Even with COVID and with the market being the way it is, we still don't anticipate property values, because it wasn't due to us or the housing market or anything like that. This whole shakeup, we don't still anticipate any kind of reduction in property values, because it's based off of all of the competition that's out there. There's still so many people looking for homes, and so you either buy now, right, and start your savings, or you continue to wait and miss out on some opportunities.
Yes, absolutely. I think that just wraps up the buy versus rent. And everybody, if you have questions, please feel free to leave your questions in the comments or contact us directly. So Adam, thank you so much again for sharing this very important information. I hope you enjoy your long weekend.
No, thank you. Thank you. I know I probably rambled that off a lot and you can see the numbers, but you know, it's not everybody finds numbers fascinating. I like the bottom line. The bottom line is the one that's like, yes,
Yeah.
155,000. That's awesome. So no, thank you so much for having me as usual. I do appreciate all of your insight in our marketplace and your expertise. You do a phenomenal job of, you know, helping your clients and everything. So I know they appreciate you. I know I appreciate you. Same.
Oh, thank you. All right, Adam. Have a great weekend. Bye-bye.